The Federal Reserve just got some news it absolutely didn't want, and it changes everything. A recent report showed an unexpected drop in jobs, and suddenly the Fed finds itself staring at a trap door. This isn't just about numbers on a screen. It's about the very path of our economy and whether we're heading for a softer landing or something much bumpier. This shift forces the Fed's hand, creating a critical dilemma that will shape markets and your finances in the months to come. Understanding this trapdoor is key to navigating what's next. Let's talk about that job report. The non-farm payrolls, or NFP, is one of the most closely watched economic indicators. It tells us how many jobs the U.S. economy added or lost outside of agriculture. Recently, it delivered a shock. Instead of adding jobs, the economy shed a significant number. This wasn't a small miss. It was a clear signal that the labor market, which has been incredibly resilient, might be cooling much faster than anyone, especially the Fed, anticipated. For months, the Fed has been saying the labor market is too strong, creating inflationary pressures. This report just pulled the rug out from under that argument. And here's where the trapdoor comes in. The Federal Reserve has a dual mandate: stable prices and maximum employment. For over a year, they've prioritized fighting inflation with aggressive rate hikes. But now, with a weakening labor market, they're caught between a rock and a hard place. Do they continue tightening, risking pushing the economy into a deeper recession and significantly harming employment? Or do they ease off, pause, or even consider cutting rates, potentially allowing inflation to re-accelerate? This NFP miss pushes them firmly towards the latter, making further aggressive hikes a much harder sell. Markets are already cheering, pricing in a less restrictive future. This shift in Fed expectations doesn't just impact stocks, it has global ripples. A less hawkish Fed, one more likely to pause or cut rates, generally weakens the US dollar. Why? Because lower US interest rates make dollar-denominated assets less attractive compared to those in other countries. This dynamic is particularly important for the Japanese yen. For years, investors have borrowed cheap yen to buy higher-yielding dollar assets. This is called the yen carry trade. If the dollar weakens significantly against the yen, that carry trade starts to unwind. Investors holding trillions in U.S. treasuries might be forced to sell them to cover their yen positions, potentially putting upward pressure on U.S. yields even as the Fed turns dovish. It's a complex but critical feedback loop. So what do you watch now? First, keep a close eye on upcoming inflation data, especially the Consumer Price Index and personal consumption expenditures. If inflation continues to cool alongside a weakening labor market, it gives the Fed more room to ease. Second, watch subsequent labor market reports. Are these job losses a one-off or the start of a trend? Any further signs of weakness will reinforce the current narrative. Finally, pay attention to every speech and statement from Fed officials. Their tone, their words, and any hints about future policy will be scrutinized. These are the levers that will tell us how the Fed plans to navigate its trapdoor dilemma. The Fed's trapdoor is a significant moment, shifting the landscape for markets and the economy. Understanding these dynamics is crucial for making informed decisions. For a deeper dive into these mechanics and a full written breakdown of the key levels and signals I'm tracking, head over to korra.finance. We'll keep you ahead of the curve.